Today, Sunday the 26th of July, 2026, the British pound is holding on to significant gains against the US dollar after a strong finish to the trading week on Friday. Pound sterling to US dollar pushed higher as crude oil prices slid lower, easing upward pressure on the greenback and giving sterling the room it needed to climb. This is not an isolated blip. It is part of a much broader story unfolding in global currency markets right now, where three forces are colliding at once: falling oil prices, rising expectations of Federal Reserve interest rate hikes, and a string of major central bank decisions due in the coming week that could reshape the landscape entirely. If you hold pounds, trade Forex, or simply want to understand what is driving global financial markets right now, the next few minutes will give you a clear and complete picture of exactly what is happening and why it matters for your money. To understand why the pound is rising, you first need to understand why the dollar is softening, and the answer begins in the oil market. Crude oil is priced in US dollars globally, which means international demand for oil creates direct and continuous demand for the greenback. When oil prices rise, countries buying crude need more dollars, and that demand strengthens the currency. When oil prices fall, that demand pressure eases and the dollar tends to soften against other major currencies. That is precisely what happened in the latter part of this week. Crude oil slid lower, the dollar followed suit, and sterling was among the currencies that benefited most. Critically, this move is not about any fundamental change in the UK economy. The pound is not rising because Britain is suddenly in stronger economic shape. It is rising because the dollar got cheaper, and in the world of Forex trading, everything is relative. A falling dollar can lift all boats, and sterling is riding that wave today. Here is where the story becomes genuinely interesting. Normally, when markets price in a greater probability of Federal Reserve interest rate hikes, the dollar strengthens. Higher US rates make dollar-denominated assets more attractive to global investors, drawing capital into America and lifting demand for the currency. So why is the dollar still softening when Fed hike bets are increasing? The answer is that the oil-driven weakness in the dollar is currently the more powerful force, outweighing the support that rising rate hike expectations would normally provide. Think of it as two weights placed on opposite sides of a scale. Right now, the oil price decline is the heavier weight, and it is winning. But this balance can shift very quickly. If the Federal Reserve delivers a more hawkish message than markets currently expect when it meets this coming week, the scales could tip decisively back in the dollar's favor, and pound sterling to US dollar could surrender these recent gains just as rapidly as they were built. That is exactly why the upcoming Fed decision is so consequential for currency traders. The week ahead, beginning Monday the 27th of July, 2026, is one of the most significant weeks in the 2026 financial calendar for anyone with exposure to currency markets. The Federal Reserve, the Bank of England, and the Bank of Japan all meet to set monetary policy in quick succession, making this a genuinely pivotal moment for global finance. For pound sterling to US dollar specifically, both the Fed and the Bank of England decisions carry critical weight. The Federal Reserve will set the tone for dollar direction. If Chair Powell signals that rate hikes are coming faster or higher than markets currently anticipate, the dollar could recover sharply. On the other side of the trade, the Bank of England's Monetary Policy Committee will deliver its own rate announcement. A hawkish bow, signaling that UK rates will remain elevated for longer to bring inflation fully under control, could give sterling additional support beyond what it is currently receiving from dollar weakness alone. The interplay between these two decisions, arriving within days of each other, makes precise forecasting extremely difficult and the potential for sharp, fast moves in pound sterling to US dollar very real. Sterling's gains this week have not come without turbulence, and understanding the journey matters as much as the destination. On Tuesday the 22nd of July, 2026, the pound dropped sharply as a flare-up in geopolitical risk sentiment drove investors back towards the US dollar as a traditional safe haven. This is a pattern that currency traders know intimately. When global uncertainty rises, capital flows into the dollar, US Treasury bonds, and gold. The pound, like most non-dollar currencies, tends to fall in those conditions. What is significant is how quickly sterling recovered from that drop. By Friday the 24th of July, pound sterling to US dollar had not just clawed back its losses but pushed meaningfully higher. This recovery tells us two things. First, the underlying demand for sterling remains intact, supported by the expectation that the Bank of England will maintain a firm stance on interest rates. Second, the geopolitical factors that drove the dollar's safe haven bid on Tuesday were not sustained enough to hold those dollar gains. Markets move fast and reverse equally fast, and this week was a textbook demonstration of exactly that dynamic. Alongside the day-to-day currency moves, a structural concern raised this week demands serious attention from anyone with longer-term exposure to sterling. BNY, one of the world's largest custodian banking institutions, flagged this week that the UK's fiscal shield is being tested, and warned of potential consequences for both the gilt market and sterling's credibility in the eyes of international investors. The fiscal shield is the UK government's spending and borrowing framework, designed to reassure financial markets that public finances remain under disciplined control. When a major institution like BNY publicly questions that credibility, it sends a clear signal that bond market investors are watching the situation very carefully. If gilt yields were to spike in response to fiscal concerns, that could paradoxically weaken sterling rather than support it, by raising serious questions about debt sustainability. For anyone holding sterling as a longer-term asset or making business plans based on exchange rate stability, this is a thread worth monitoring closely. Short-term, GBP can climb on dollar weakness. But fiscal credibility is the foundation that durable, long-term exchange rate strength is built upon. Beyond the charts and the central bank language, what does today's stronger pound actually mean for ordinary people and businesses across Britain? For companies that import goods priced in US dollars, whether that is technology components, raw materials, or American-manufactured products, a stronger pound is a direct cost saving. When £1 buys more dollars, your import bill in sterling terms falls, and those savings can be passed on to customers or absorbed into margins. For UK consumers traveling to the United States, a stronger pound means a better exchange rate at the bureau de change, making every dollar of holiday spending go further. For British investors holding US equities or dollar-denominated funds inside their portfolios, the picture is rather different. You may be making gains in dollar terms, but those gains shrink when converted back to sterling at a more favorable rate. And for active Forex traders, this week's combination of oil market volatility, shifting Federal Reserve expectations, and approaching central bank decisions has created exactly the kind of high-stakes environment where significant returns, and significant losses, are made in very short order. Looking ahead to the week beginning July 27, 2026, the central question for pound sterling to US dollar is which force wins the ongoing tug-of-war in the market. If oil prices continue their downward slide, dollar weakness persists, and sterling could hold or extend its current gains. But if the Federal Reserve delivers a hawkish surprise, the dollar could recover sharply regardless of what is happening in the oil market. The Bank of England's own decision will be equally pivotal for the pound's direction. If the Monetary Policy Committee signals that rate cuts are on the horizon sooner than markets currently expect, sterling could give back its gains quickly, even in an environment where the dollar remains generally soft. A hawkish Bank of England combined with continued oil price weakness, on the other hand, could push pound sterling to US dollar meaningfully higher through the early part of next week. Traders will be watching key technical support levels closely, as holding the levels established during Friday's rally will be essential for sustaining bullish momentum. The honest assessment is that next week is binary, outcomes depend on decisions that have not yet been made, so position sizing and risk management matter now more than ever. Let us bring everything together into a clear and complete picture. The British pound is rising against the US dollar today, Sunday the 26th of July, 2026, because falling crude oil prices have softened the greenback sufficiently to outweigh the upward pressure that rising Federal Reserve rate hike bets would normally apply. It is a story about interconnected global markets, where oil prices, interest rate expectations, geopolitical risk sentiment, and fiscal credibility all feed directly into the exchange rate displayed on your screen. The week ahead will be decisive for pound sterling to US dollar. Three central bank decisions, from the Federal Reserve, the Bank of England, and the Bank of Japan, will each carry the power to reshape currency markets significantly and rapidly. Whatever your reason for following this story, whether you are a trader managing open positions, an investor reviewing your portfolio's currency exposure, a business planning your cash flow, or simply someone curious about how global financial forces work, understanding these interconnections puts you in a stronger position to make informed decisions. Subscribe now for full coverage of next week's central bank decisions the moment they land.